Welcome to the deep dive. Today, we're not just looking at a market sector. We are basically tracking a three-way street race in the consumer cyclical world.
That's a good way to put it.
We ran a stock screener on auto and truck dealerships, just looking for the biggest players by market cap. And what we found is this trio of companies, Carvana, CarMax, and Valvoline. Their performances are just. They're moving in such dramatically different directions. It's a real masterclass in market psychology.
It really is, and that's an understatement. You have Carvana, that's CVNA, then CarMax, KMX, and Valvoline, VV. They're all technically in the same sector, but, they represent three wildly different investment narratives right now.
Exactly. You've got the hypergrowth disruptor, the struggling incumbent, and then the high-margin service specialist.
A perfect summary.
So our goal today is to give you, the curious learner, a complete picture of what is driving this divergence. We're going to approach each company through three lenses. The fundamentals, valuation and financial health.
The technical, so price action and risk indicators.
And, of course, the news flow that fuels, or in some cases crashes, the whole story.
And before we really jump in, just a quick but important note. The figures we're about to discuss, including our little paper money math exercise, they're all drawn from historical data and public sources.
Right.
So the deep dive is purely informational. It's for learning. Please think of it as an engaging exercise, in pattern recognition, not as actual investment advice.
Okay, with that said, let's unpack this high-octane sector. We have to start with the undisputed headline giant, Carvana Co., ticker CVNA.
Of course.
With a market cap close to $97.5 billion, CVNA is the leader. And its recent performance has been, absolutely explosive.
CVNA is the poster child for momentum investing right now. I mean, if you bought shares 5 years ago, you'd be up nearly 80%, which is great.
This is great on its own, yeah.
But the 3-year return is over 5,400%.
Wow.
This kind of massive outperformance isn't just growth. It's a fundamental shift in how the market sees the business model.
And here's where the narrative really reached a fever pitch. The biggest recent catalyst was the news of its S&P 500 inclusion. That sent the stock surging 12% in a single day back on December 8th.
And the analysts just piled on.
Oh, immediately. Analyst sentiment turned aggressively bullish. UBS initiated coverage with a buy rating of $450 target. JP Morgan raised their target even higher, up to $490. It's all disruption, scale, acceleration.
And this brings us to the core analytical challenge of CVNA. It's this cognitive dissonance. The growth story dictates an extremely stretched valuation. The trailing PE ratio sits at an astronomical 102.05.
A triple-digit PE. That's usually reserved for a biotech company that might cure cancer, not a used car retailer. What does a price tag like that even tell us?
It tells us the market is entirely 100% focused on future earnings. They're betting Carvana will completely dominate the online used car space. The projected earnings per share growth over the next 5 years is exceptionally high at 69.10%.
69%.
So when you put the PE against that expectation, the PEG ratio, which ideally you want near 1, it comes in at a quote-unquote favorable 1.47. It suggests the valuation is, it's somewhat justified if that acceleration holds.
But if I'm a skeptical investor, that near 70% growth rate projected over 5 years feels almost like a fantasy number. Where do I find the data that proves they can actually sustain that?
And that's where we hit the flashing neon contrarian signal. Despite the booming growth, strong operational performance like a gross margin of 20.52% and a high return on equity of 43.53%, and all that analyst optimism.
Insiders are selling.
Heavily. That is the ultimate head-scratcher.
Right.
Insider transaction data shows aggressive, repeated, and large sales and option exercises by the CEO, Ernest C. Garcia III, and other officers all through the fall and into December. They are actively taking chips off the table. Insider ownership is just 6.47%.
So when the people who know the company best are consistently locking in profits.
Precisely. It forces you, the curious learner, to question whether management truly believes the stock price is sustainable at these extreme levels.
Let's turn to the technical picture, which sounds just as wild. With a recent close of $447.98, what are the technicals telling us about the sheer risk here?
The technicals scream high risk, high momentum. The stock has a high beta of 3.56.
So it moves over 3.5 times as violently as the market.
Exactly. To put that in perspective, the average true range, or ATR, is a massive $21.94. That means the stock moves, on average, $22 up or down on any given day. That's truly violent movement.
High risk, high reward. And it sounds like we have a major technical traffic jam right now.
We do. The momentum from the S&P inclusion has driven the Relative Strength Index, the RSI 14, up to 77.44.
And anything over 70 is considered.
Highly overbought. The RSI measures the speed and change of price movement, so this signals technical exhaustion. It suggests a strong likelihood of an immediate pullback after that huge spike.
Okay, let's run the numbers on this incredible trajectory with our paper money exercise. Imagine you had put $5,000 into CVNA near its 52-week low of $148.25. What's the return?
Okay, so assuming you rounded down and bought 11 shares at that low, your total investment cost would have been about $1,630.75.
Okay.
Selling those 11 shares at the current price of $447.98 gives you a total value of $4,927.78.
So you're looking at a 202% return in under a year.
202%. That is the jaw-dropping reward that fuels the whole CVNA narrative.
Okay, so if CVNA is flying 200 miles per hour on S&P fuel, CarMax is the incumbent that just hit a massive operational pothole. Let's look at why KMX's vehicle is sputtering.
A completely different story.
CarMax Inc., ticker KMX, much smaller market cap of $5.77 billion, and it's facing serious headwinds.
The news flow for KMX has been disastrous lately. I mean, in November, they abruptly sacked the CEO, which came right alongside an announcement of weak preliminary results.
Not a good combination.
No, it triggered a wave of analyst pessimism. We saw multiple downgrades. JP Morgan moved to an underweight rating. They set a target price of $30. That's significantly below the current $39.26.
And in a really painful contrast to CVNA's index inclusion, KMX is actually being ejected from the S&P 500.
Ouch.
Yeah. And on top of all that, they're dealing with numerous investor lawsuits over alleged securities law violations, citing things like temporary demand pull forward and loan portfolio risk. It's a classic distress scenario.
Fundamentally, KMX looks extremely cheap compared to Carvana, but we have to ask if it's, cheap for a reason.
Right.
The PE ratio is just 11.53, and the price to sales is a very low 0.20, and most strikingly, the price to book, or PB, is 0.94.
Okay, slowing down there, that PB of 0.94 is a really critical piece of information. What does trading below book values signify for the curious learner?
It means that, theoretically, if CarMax sold all its assets tomorrow, shareholders would get more than what the current stock price implies. It often signals deep, deep value, but in this context, it's a clear sign of deep market distress, a real lack of confidence in the company's ability to generate future profit from those assets.
So the valuation screams value, but the financial health shows strain.
Precisely. Earnings per share this year is down significantly at negative 15.21%. Their operating margin is a slim 2.87%, which is worlds apart from CVNA's profitability.
And they're leveraged.
Very leveraged. They're carrying a high debt-to-equity ratio of 3.12. When you combine high debt with falling earnings, that deep value, well, it quickly starts to look like a value trap. We should also note institutional ownership is unusually high at 102.19%, suggesting big funds are holding on even as the stock sinks.
And from a technical perspective, the price action seems to just confirm all this fundamental weakness.
Absolutely. The technical picture is uniformly negative. The stock is in a massive downtrend, confirmed by the fact it's trading almost 34% below its 200-day simple moving average. Performance metrics are ugly year to date. It's down over 50%.
51.98, yeah.
This just signals major structural weakness that hasn't found a bottom yet.
So let's apply our numbers to the inverse scenario here. What happens if you bought KMX 6 months ago, maybe betting on a turnaround, and held through this operational collapse?
That was a punishing hold. Given the half-year performance is down over 41%, if you had invested $5,000, you would have purchased roughly 127 shares 6 months ago at an implied price of about $67.21 per share.
And selling those today at $39.26.
Would result in an estimated loss of $3,549.95.
Losing over $3,500 in 6 months. That really illustrates the brutal penalty for operational setbacks in this environment. What's the biggest lesson here? Is it that value traps aren't always cheap? or that the market will punish poor execution immediately?
I think the lesson is that a cheap valuation is often a reflection of risk, not opportunity. When a stock trades below book value, it signals a massive loss of market confidence. It takes significant time and clean operational execution to rebuild that trust, and KMX has done the opposite recently.
All right, now we switch gears entirely. We've looked at the disruptive online drag racer and the struggling retail sedan. Now let's pull into the high-margin service bay and look at Valvoline, ticker VVV.
A whole different ballgame.
This company, with a market cap of $3.98 billion, it doesn't sell cars at all. It sells maintenance.
And that's key. VVV focuses exclusively on engine and automotive maintenance services and products, which gives it a more recession-resistant and high-margin economic profile. Their strategy is all about network expansion. We saw that with the recent acquisition of Breeze Auto Care, which pushed their location count past the 2,000 milestone.
While their Q4 earnings missed estimates, the news flow suggests internal confidence in that strategic growth. We saw their CEO, Lorianne Flees, actively buying 4,500 shares in November.
Valued at over $138,000. That's a positive insider signal, especially compared to the relentless selling we saw at CVNA.
A huge contrast.
When we look at the financials, VVV's unique business model really shows up in its profitability metrics. They boast an exceptional gross margin of 38.50% and a strong profit margin of 12.32%.
That's the stability of a service company versus the volatile, razor-thin margins of retail car sales.
Exactly. Their return on equity is also exceptional at 81.97%, illustrating a highly efficient use of shareholder capital.
So stable profitability, strong margins, and management confidence. The valuation is also much more reasonable than CVNA. A PE of 19.13, a favorable PEG of 1.33. Are there any financial tripwires here? Anything on the balance sheet?
Well, what's fascinating here is that despite the excellent profitability, Valvoline is running on very high-octane debt. They carry a very high debt-to-equity ratio of 4.93.
That is high.
And furthermore, their quick ratio is quite low at 0.58.
Okay, the quick ratio. That's a key liquidity indicator for our learner. A low number here means what exactly?
It means that if VVV had to pay off all its short-term liabilities immediately using only its most liquid assets like cash or receivables, they might struggle. That low quick ratio, combined with the high leverage, suggests that while the market rewards their high margins, the company is managing significant financial risk and balance sheet pressure.
And on the technical side, VVV lacks the dramatic swings of the other two. It sounds like it's the steady climber in our street race.
It's relatively stable and neutral right now. The stock is currently recovering from a previous dip, with the 20-day simple moving average showing some slight positive momentum. However, the 50-day and 200-day SMAs are still negative.
And the RSI?
The RSI is neutral at 47.51, confirming a lack of any extreme overbought or oversold conditions. Performance month over month is basically flat.
Let's calculate the reward for that stability with our hypothetical long-term hold on VVV. We'll look at the return over the past 5 years.
Okay, VVV has a solid 5-year performance gain of 36.01%. So if you had taken $5,000 and purchased 159 shares 5 years ago, holding until today, the estimated profit would be $1,316.31.
So it's a return that's less spectacular than CVNA's recent surge, but it represents consistent, profitable, reliable operations.
It's the classic reward for stability over disruption.
This analysis provides such a compelling contrast, wrapping up our three-way deep dive. We've seen CVNA, the high-growth disruptor, driven by narrative, index inclusion, analyst targets reaching for the moon, all while insiders are actively selling into the rally and the technicals scream overbought.
Then there's KMX, the incumbent suffering from an operational collapse, management changes, index ejection, legal trouble. It's trading below book value and serving as a painful reminder of the risks in value traps.
And finally, VVV, the high-margin but leveraged service specialist, delivering steady long-term returns but requiring you to keep an eye on that high debt load. These three companies, all operating under the umbrella of automotive consumer cyclicals, could not be less alike in their risk profile and market performance.
The key takeaway for the curious learner here is how powerful market sentiment truly is. The positive news of S&P 500 inclusion and these massive growth projections for CVNA completely overwhelms traditional concerns, like a PE of 102 and insider selling. Conversely, KMX's operational setbacks trigger massive market penalties, even though its assets look cheap on paper. It just shows that in today's market, the narrative often dictates value more than the balance sheet does. at least until a crisis hits.
So these three stocks represent three distinct financial approaches growth at all costs: the turnaround challenge and the stable utility play. They really force you to decide what kind of risk you're willing to take.
Which leaves us with this provocative thought. CVNA's massive valuation is predicated on a future that must materialize perfectly, yet the insiders are liquidating their holdings. KMX is cheap, but it continues to sink. For you, the curious learner, is the bigger fundamental risk paying too much for perfect potential in the form of CVNA, or buying something cheap that just keeps getting cheaper, like KMX? How long can momentum outweigh the cold, hard questions of operational stability and solvency?